Good afternoon, students. Welcome to another class session as we go into a very interesting topic in our subject matter, economics. Hope it has been fun so far. Today's topic will be dealing with market structures. Market structures. Okay. Now, when we talk about the market structure, what is a market structure? Or what is a market? Now, I've had various students bringing out their own misconceptions about what market is. Now, when we talk about saying market or market structure, market simply means it shows the point of contact, okay, between what buyers and sellers. Market does not necessarily mean a particular place or destination, because you can be in your various houses, you can be in any point in time, and due to the global world and through the internet, you can actually do so many things at various places at the same time. So therefore, due to this global factor, markets can never be a place. Now, there is a distinction between market and market structure. So the question is, what then is a market and what then is market structure? Now, let's define what a market is. A market can be defined all right. So a market is a point of contact, okay, between buyers and sellers in order to what? To meet up or to transact a particular business deal, okay? Very simple as that. So a market is just a point of anything that brings into contact the buyers and the sellers of a particular product, then we can call it what? A market. Now, if you take a look at what is the body and what is the body structure, okay, they are kind of two separate things. So when we say a market is the point of contact between a buyer and a seller so that they can transact a particular deal. It can be the buying of goods, tangible goods, or it can be the buying of of a service. Now, we all know when we talk of tangible goods are goods like product that we can see, we can touch, okay? And when we talk about intangible goods, we can refer that as services. Now, when we look at the market again, the market is just telling us point of contact, okay, if we are aware about that. Now, let's now take a market structure. Now, looking at a market structure does look at the various components of the market. The various components of the market. Example, price structure. Example, product structure. Example, service structure, and all that. All other factors that enables the functioning of a market. So it means that there is a clear distinction between between a market and a market structure. So let's put down the definition of a market structure. Okay, so we can see it can be defined as the various components that a market constitutes of. So if you have this as being a market structure, now market has types. Market structure has types. So let's see the types of market so that we can now see the clarification. Then we can see the distinguishing factor between the market structure. In terms of definition, we've seen the clear distinction. We've seen the difference already in terms of definition. In terms of definition, a market is just a point of contact. But market structure goes deeper into the market. All right, so let's see types of market. Now, what do you think can be the types of various markets that we have? Now, definitely we have a product market, we have service market, foreign exchange market, and all that. So, in quote or in general term, we can just say we have what you call the commodity market. Now, secondly, we have the money market. we have the capital market. We have the foreign exchange market. Okay. So these are the 5 major types of market that we have. Commodity market, money market, capital market, and the foreign exchange market. Now, what then is a commodity market? Now, we can classify the commodity market as any forms of market where you can buy sellable goods and services. Sellable goods and services. Goods like food items, household goods, any form of product that you can ever think of. Laptops, technological wares, and all that. Even clothes, shoes, and all that. All those kind of things are classified under the commodity market. Then we move to number 2, which is the money market. Now, when we talk about the money market is just a market where short-term monetary instruments are bought and sold. Where short-term monetary instruments are bought and sold. Now, that is the money market. Not only short-term monetary instruments, we can also say short-term finances. Anytime you think of short-term finances, that is maybe you want to borrow an amount of money for a period of less than 12 months, or you want to ascertain a particular asset in which can turn into cash within a period of 12 months, you can call that a money market. Now, let's come to this side and let's see some examples of the money market. Now, looking at the money market, we say money market is where short-term finances are bought and sold, or short-term securities are bought and sold. So let's see some instruments in the money market. We can have the treasury bills. Secondly, we can have what you call the treasury certificate. Thirdly, we can have something like bills of exchange. Fourthly, number 4, we can say commercial paper. Now, look at the surprising thing about these things. Now, if you take a look at treasury bills, let's see the time period, okay? Now, the time period of a treasury bills at which you can convert it to cash is just within a period of 91 days. That's all. So we can see 91 days is just a period of like 3 months. Okay, 91 days, okay, 3 months. Then if you take a look at treasury bills, treasury certificate is a period of 1 year, exactly 1 year. Then when you take a look at the bills of exchange, the bills of exchange is also 90 days or 91 days. Then same as the commercial paper, 91 days. So we can see it is only the treasury certificate that has a period or a payment period of 1 year. That is the validity, okay? The validity of all these assets or of all these instruments takes a period of less than 1 year. The only one that takes 1 year on the dot is treasury certificate. Now, all these certificates here, they are used to source for for funds, or we can use it to source for money in the various financial markets, okay? Now, let's now move on to the capital market. Now, looking at the capital market is just an exact opposite of the money market. If the money market is a market where you exchange or you trade short-term finances or short-term monetary instruments, then we can say the capital market, it is a market where long-term securities are traded. Let's put the so let me just define each and every one here. So commodity market, So for commodity market, we can say these markets now we move on to the capital market. Now, on the capital market, we can say these are markets. We are long-term. That's a long-term finances or securities are traded. All right. So let's take some examples. You can have shares. You can have mortgage. You can have stocks. You can have gilt edge. All right. Now, we can also have debentures as well. Okay, that's why ETC and so on and so forth. Now, let's take each and every one of them, the shares. Now, when we take a look at a share, we all know what a share is, right? Now, a share is just looking at the independent unit of a company's capital structure. The independent unit of a company's capital structure. Meaning, if you own a particular company's share, it means automatically you become a shareholder. So therefore, you owning the share of a particular company, you must pass through the normal processes before you can do that, okay? It has just few processes, then you can become shareholders. And right now, I think shareholding, buying shares of company is very, very lucrative, okay? You can just go online and search some blue chip companies that you can easily become a shareholder with just few amount of cash or something like that. So now, if you take a look at shares, you becoming a shareholder of a particular company, you actually earn dividends in return. So what does that mean? What it means is that shares is under the capital market because shares does not only last for 12 months. It lasts for more than a period of 12 months. For instance, when someone owns a share for, let's say, First Bank, every year the person receives dividend. So virtually or literally speaking, as we look at it, it means every year it is what? It's a long-term basis. A long-term base. The person gets paid every year. So we can see it's not a short-term thing. It is what? It's a long-term. So that is why it is under the capital market. Mortgage. Mortgage are funds that are being given to what? To people so that they can undergo some capital structures. Now, the capital structure we are looking at, or the capital project we are looking at here is what? Buying of landed properties or building of houses. So anything that involves the buying of houses or the buying of landed properties, lands, and so on, then you can call that mortgages. Now, take a look at stocks. Now, when we take shares, we are considering shares as what? As independent, okay? As what? Independent, that is, as a unit. Now, if you now take stocks, stock is just considering the group of shares or the collectivity of shares. So whenever you bring shares together, then you can call it what? A stock, okay? Then we move ahead to gilt edge. Now, anytime we say the word gilt edge are financial securities that are used mainly by the government. So government can also source for money in the what? In the capital market. And how do they source for money? They source for money using what? The gilt edge financial security. Now, let's take the foreign exchange market. Now, the foreign exchange market, this is where you buy or you trade currencies. Currencies like Naira, currencies like dollar, currencies like yen, the Japanese yen, currencies like Dalasi, currencies like Leone for Sierra Leone, and all that. Okay, so these are markets where you can exchange currencies. Okay, so anytime we talk about the foreign exchange, so we can see it clearly that these are markets where where currencies are traded. So any market where you trade currencies, then we can call it the foreign exchange market. Now, we've seen the types of market, and each market tells us what we can get from them, okay? We can see that in the commodity market, we get foodstuffs, household goods, and other forms of goods like your technological wares and all that. Now, the money markets are telling us what we can get from them, which is what? Short-term finances or financial instruments or financial securities. The capital market also tells us what we can get from them. Then the foreign exchange market also tells us what we can get from them. Now, let's now go into market structure now. Since we've seen the various types of market, there is a need to also see the various types of market structures. Now, we've seen the definition already, right? So what are the types of market structure? Types. Market structure types. Now, type number one, we have what we call the perfect market. Then number two, we have the imperfect. So number one, what do we have here? The perfect market. Then number two, what do we have? The imperfect market. Now, taking a look at the perfect market, let's see the definition. What is a perfect market? I know you all be thinking a market that is perfect or a market that has no stain. Now, whenever you think about a perfect market is defined by its distinguishing characteristics. Now, if you take a look at the perfect market, number one characteristic is they have large numbers of buyers and sellers. They have homogeneous price and product. They have what you call atomicity axiom. Now, let's take a look at the characteristics. So let's take the characteristics of a perfect market. Now, now looking at the characteristics of a perfect market. Now, number one, we have large numbers of buyers and sellers. Number two, we have the uniformity in price. Number three, we have the homogeneous product. Number four, we have the absence of transport cost. Then number five, we have the free exit and entry. Now, these are the distinguishing features that we use for the definition of a perfect market. So a perfect market in real sense has no clerical definition. The only definition it has, it is defined by its unique characteristics. Like number one, the large numbers of buyers and sellers. Number two, the uniformity in price. Number three, the homogeneous product. Number four, the absence of transport cost. And then number five, the free exit and entry. Now, I said something earlier called atomicity axiom. Now, when we take a look at atomicity axiom, the atomicity axiom refers to point number one, which is the point of what? Large numbers of buyers and sellers. Now, this is what you call atomicity axiom. Now, let me put that down, or you can say this to be, so point number one, atomicity axiom. Atomicity axiom. Now, so it means that when we say atomicity axiom, this is what we mean. Now, for a perfect market, we can also call it axiomatic market. Axiomatic market. So anytime we talk about a perfect market, another name for a perfect market is what? Axiomatic market. So let me write this very well to you. Okay. Point one above can also be called atomicity. It's X. It's XY. So atomicity axiom. All right. Okay. So this is what you can call the point one, the atomicity axiom. Now, let's take each and every point and let's see. Now, taking a look at the large numbers of buyers and sellers, which is true. Now, when you take a look at a perfect market is a market wherein you have a lot of people buying a particular good and a lot of people selling that good. So it means that in that kind of market, you have what you call a uniform price. You have what you call absence of transport cost, and you have what you call free exit and entry. Free exit and entry means you can go into selling a particular market, and you can leave that market and change into another market anytime you deem fit, anytime you like. No one is holding you down. There's no restriction of entry. Okay? You can enter into the market, start the production of whatever you want to do, and you can leave anytime you want to leave. So that is what we call a perfect market. Now, since we have a perfect market, okay, now, how then do they make profit? Or what is their profit structure like? Since we are looking deeply into market structure, we also need to know how a perfect market makes profit. So we are going to do that here. Now, a perfect market operates in two situations or in two conditions. The first condition we have is the long run or the short run. So I would like to start with the short run first. So we are going to call this the short run profit maximization. Maximization. Now, looking at the short run profit maximization, how do they maximize profit in the short run? Now, for the short run, anytime we talk about a short run situation is a point in time where a particular business can vary some of their factors of production, and while others can also be left to be what? Fixed. You don't make all of them fixed, neither do you make all of them to be what? To be varied. It means some are fixed while others varies. So with that kind of thing, for example, when cooking, there are some items that you can do without when cooking. And there are some items that whether you like it or not, you have to include in your cooking. So it means I can literally say cooking is what? Is a short run kind of thing. But when you talk about the long run is when you can vary all materials or you can vary all factors. Are we there? Now, looking at the short run profit maximization, the profit maximization is always a point. Never forget this. It is always a point where MR must always be equal to MC. MR must always be equal to MC. That is point number one to note. Now, whenever we talk about profit maximization, be it in the long run, be it in the short run, your MR must be equals to MC. Now, the question here is, what is your MR and what is the MC? MR simply means the marginal revenue and MC simply means the marginal cost. The both of them must be equal so as to ascertain the level at which you make profit. Okay. Now, point number two, your MR must be equal. Your MR must be equal to your demand which must be equals to your AR and must be equal to your price. Now, this is the third point. Now, the third thing is we need our MC. Or we can just say a sketch of MC, the marginal cost curve. Then number 4, we also need a sketch of the